Accruals, the Principles of Accounting, and this is CPA Kulwa Mangana, an assistant lecturer from the Open University of Tanzania, a faculty of Business Management, Department of Accounting and Finance. And today we are going to look at accruals and payment. This is accruals and prepayments, and we are going to look at in-depth understanding of the accruals, what we mean by accruals and what we mean by prepayments. But furthermore, we're going to look at the accounting treatment when we have accruals and when we have prepayments. Okay, so I hope you're going to be comfortable at the end of this session. It is my expectation that you'll be able to employ the knowledge behind the accruals and prepayments before you prepare your final accounts. Okay. And normally, accruals and prepayments, we normally involve them, or we normally take them into consideration at the end when we are going to adjust the final records before we come up to the final account. It is normally included when we have the adjustment of figures, and probably in most cases when you have your trial balance, then you have to adjust for accruals and prepayment. Okay, so that's the point whereby you need to take them on board. Okay, now we are saying before we prepare the final accounts of the business, it is very, very often and very, very important to adjust for these figures, and normally the trial balance is a helping tool to adjust these figures. Okay, now to start with, what we mean by accruals. What we mean by accrual. An accrual is an estimate of money that is owed by which has not yet been paid. I repeat, an accrual is an estimate of money that is owed but which has not yet been paid. So that was accrual. Okay. Now, what do we mean by prepayments? Prepayments. The term itself, prepayments. Pre, which means pre stands for prior, and we know what we mean by payment. Okay, so prior payment. So prepayments is payment made in advance of the current period. Payments made in advance of the current period. So that is meant by prepayments. Okay, let me write it here. If I write it here, it will be easy for you to understand. Okay. An accrual is this is an estimate, and there's a reason why we are saying this is an estimate. But remember, with an accounting, we said remember the principles. We said that one of the principles is money measurement. So we're going to record money measurement. It requires us to record transaction in monetary terms. So it is an estimate of money. It is an estimate of money, and there's a reason as why I'm saying it is an estimate of money that is owed. It is an estimate of money that is owed, but has not yet been paid. Okay. This is a simple definition of what we mean by accrual. Accrual is an estimate of money that is owed but has not yet been paid. That's why we say it is accrued. Okay. Now, vice versa of it is a prepayment. Okay. So what is a prepayment? As I've said, pre, which means is prior, prepayment. Prepayment, that means payment made in advance. Prepayment means payment made in advance. Payment made in advance. So that's what we mean by prepayment. In advance of what? In advance of the current period. In advance of the current period. Okay. For example, when you're having a period of 12 months, for example, your accounting is running from January, 1st of January to maybe 31st of December. this is a 12-month period, and then for example you're having expenses, let us say electricity expenses. Then if it happens that you paid more, for example, you are in the month of November, and then you just paid an extra 2 months, for example, you just paid for January again, and you just paid for February in the coming year. So the 2 months that you've paid, we're saying you've prepaid, you've paid in advance. Okay, so we are going to look at the accounting treatment for prepayments and accruals. Why? Because when you're going to prepare financial statements, or when you're going to prepare your financial records, it is to cover that period. If you refer again to the accounting principle that is called the accounting period, it requires us to record the accounting information into a specified period of time, and normally within a period of 12 months. So if you have a transaction that has exceeded that period, or it has gone beyond that period, you have to adjust it. That's why we have accruals and prepayments. Okay. Now let us start with accruals, and to make it this simple, I'm going to give you a number of examples whereby you'll be able to understand what we mean by accruals and expenses. Now, an example of an accrued expense. Okay. Let us start with an example of an accrued expense. Assume you have a business that has an accounting period that ends 31st December. Okay. Now you have a business that has an accounting period ending 31st December. Okay. So that is an assumption that you have a business with an accounting period that ends 31st December. And again, on 1st January of assume our year 2006, on 1st January of our year 2006, electricity, we have an electricity owing amounted to let's say 400. We're going to use small figures for the purpose of learning. Now let us assume on 1st January of 2016, should we use 2016 or current year? Let us use current year because now we are in 2020. 1st January 2020. 1st January 2020, we have an electricity owing amounted to let's say 400. This might be Tanzania shillings, whatever the currency that you use, but I want you to understand the concept for accruals. Okay. So this is the case. We have an accounting period that ended 31st December, but on 1st January 2020, we have electricity owing amounted to 400. So this is the bill. Okay. And the business, we also assume that the business is paid 3,000 during the year. But we have paid, or the business paid 3,000 during the year. During the year. So that is again an assumption that the business is paid. The business is paid 3,000 during a year. But lastly, there is at the end of 37 December, there is an amount that is owing for electricity at this period. Okay, so we have again at the ending period, we have an amount owing for electricity. There is an amount owing of 250 for electricity. So you see, we have these cases that accounting period is ending 31st December, but at the end of the period, that is 1st December, this business is owing to an amount of 250 for electricity, so you're supposed to pay that. But again, at the start of the period, at 1st January 2020, electricity was also owing amounted to 400. But during the whole period of 2020, and then I assume I've extended. I know that we've not reached, but this is for the purpose of understanding. Now, during the year 2020, we paid 3,000 as an electricity expenses. Now you from this from this case now, you can understand that we have cases here whereby accruals comes in. Now, referring to the definition of accrual, we said definition of accrual when we were defining accrual, we said is an estimate of money that is owed, an estimate of money that is owed and which has not been paid. Okay. So now let us see the accounting treatment. Let us see the accounting treatment of this. Now this is the electricity account. As I've said, we have debit and credit side. So you see, at the start of the year, 1st of January 2020, the balance BD, because you see now electricity account this is an expense account, it has a nature of debit, but now since by the start of the year, there was an amount owed. There was an amount owed of 400. So that amount owed, it is going to be on the other side of account. So you say balance brought down here, it should be 400. This amount was owed and it was supposed to be paid by the start of the year. Okay, you are going to have your date here. This is 1st January, but I'm trying to simplify it. And then during the period we paid. Electricity expense of 3,000. If you pay an expense, we all know that an expense is has a nature of debit, because you've paid, which means you've credited your cash account if you paid through or using your cash account or bank account, and then the corresponding entry is the debit. So you're going to debit this account. You're going to debit for, let us assume that we paid it by bank, so you're going to debit 3,000. Okay, I hope it makes sense. This was the liability by the start of the year, and then during the period you just paid 3,000 as electricity expense. I hope you can follow. Now, but we are also told at the end of the year, as at 31st December, there was also still an amount owed. Now we see at the end of the period we have balance CD, balance brought down of 250, because this was an amount that is still owed. I'm trying to put this figure here so that we can be able to understand. Okay. Now, how are we going to account which amount or which figure we are going to take it to the profit and loss or to the income statement, and which figures are supposed to be taken to the balance sheet? That is very, very important, and this is what I'm going to demonstrate here to be for you to be able to understand the adjustment. And to start with is with the accruals. Okay. Now you're going to close it here. I remember with our previous lecture, I did show you. We went through on how to closing an account. This is a normal account, and then you have to see the totals from the both right hand side and the credit side. Which one gives you a bigger figure? This is 400. This is 300 plus 250. It's going to be 300 and 250. So this figure is this side has a much bigger figure compared to the other one. This one is 3,250. So you're going to put it here, and then the next figure is going to be, you're going to take it to the profit and loss. P and L is all the income statement. I'm just going to shorten it by saying it P and L, or I can even write it here because it is for the first time. Profit and loss. So the difference here, it is going to be how much? It's going to be 2,850. If you take 3,250, you minus 400, you're going to get 2,850. So this is the figure that we're going to take. It is an expense during the year for the period under review. Now, if you look at it very closely, you can even review it that if at the start of the year this was an amount owed, it was supposed to be paid, but during the year we just paid this amount. But at the end of the year, there was this amount also. It was owed, and then let us establish how much we're going to take it to the profit and loss is an expense during as an expense within that period in the accounting treatment. Okay, so that's how it should be. Now let us see what figure should be taken to the, as I say, what figure should be taken to the income statement and what figure should be taken to the balance sheet. Now the profit and loss statement is the same as income statement, so definitely we know this figure is the one that is going to be taken to to the income statement on the debit side. But again, since at the end of the year we were also still having an amount that is still unpaid, so it is still an accrued expense, that is an unpaid balance of electricity. So an accrued expense, this is a liability, so it is going to be taken to the liability side of a balance sheet. So this figure is going to be taken to the balance sheet, and this figure is going to be taken to the income statement. So that's how an adjustment of accruals should be treated. So you can even come up with an extract of an income statement or balance sheet. Sometimes you might be asked to draw an extract. Sometimes you might be told in exams to prepare an extract of a balance sheet, so, or an extract of a profit and loss account, or an extract of income statement. So this is what you're going to do. This is an extract, so you can even write an extract. So to start with, this is the profit and loss account. Profit and loss account. Remember, I'm saying this is an extract, profit and loss account for the year. For the year ended. Remember, you have to write it for the year ended 31st December. Our year is 2020. So an extract. You're going to have your other figures. For example, you're going to have if you are having other expense, for example, the sales, cost of sales, the gross profit, and so forth. But remember, we're going to put we're going to take an extract of where exactly these figures, the accrual expenses, it is going to be located here. We know that it is going to be located under the expense side, and then here under the expense, you're going to put your electricity as operational expense. Remember that figure 2,850. So simply like that. This is an extract of the profit and loss account. This is how it is supposed to be. It is supposed to be seen simple, clear, as that way. Okay. But again, you might also be told to come up with an extract of a balance sheet. So you're going to do the same thing here. Instead of writing a profit and loss account, it is going to be balance sheet. Extract. Remember, this is an extract. Extract balance sheet for the year ended 31st December 2020. But here again, you are going to take that figure to the current liabilities, because with the balance sheet, remember I've been telling you from the previous lecture, balance sheet has three elements that are going to be found in the accounting equation. You're going to have your assets, liabilities, and capitals. Now here with the liabilities, you have long-term liabilities and current liabilities. Now under the current liabilities, because an accrued expenses should be paid within that period or in the future. So this is going to be under the current liability. Under the current liabilities, down here you're going to put your electricity. Accrued, whatever the names. Sometimes others are saying accrued electricity or electricity accrued. We're going to be putting there your figure. Okay, so that is simple, and that is the accounting treatment of the accruals and the representation of it from the income statement and from the balance sheet. Okay, I hope it is very clear now. Now, after having a discussion on accruals, now let us come and discuss something else. Another element of prepayments. Okay. Now let us see an example again. Example of prepaid expense. Okay. Now let us assume that you have a business that also runs with an accounting period. You're going to use the same. That our accounting period ends 31st December 2020. Okay. Now time is running very fast. You never know. You might be finding yourself in the near future. You have reached 31st December, because now it's January. Now we are left with almost like 11 months up to 2020 December. Now assume that you have a business that is an accounting period that runs or ends with at 31st December. And then on 1st January of 2020, the year 2020, you have an insurance of 300 that has been paid in advance. January 1st, on 1st January 2020, you had an insurance that was paid in advance. Let's come up with a figure. Let us assume that this insurance was paid at an amount 300, okay? Because we're going to use a hypothetical figure. Now assume that we had an insurance that was paid in advance of 300. So this, by the start of the year, we paid this amount in advance. But again, during the year, we assume that we paid how much? Let us assume we paid 2,000 as an insurance expense for insurance that we instituted our bank to pay the insurance company this amount for the year, okay? However, this included a prepayment for 100 for the year beginning 1st January in the forthcoming year. Now we assume that again in 2021, okay, there was an advance payment of 100 that was paid within this figure. That during the year we paid the insurance cost of 2,000, but within this 2,000 there was an advance payment for January 2021 of 100 shillings. Okay, so this is the case. I'm going to make it simple again. At the end, we have an accounting period that runs 31st December. Now, on 1st January of 2020, an insurance was paid in advance with this amount 300. But during the year, we paid 2,000. But this 2,000 include an advance payment of 100 that covers for the year 2021. Okay. Now that is the case. This was paid in advance. We paid this during the year, but payment during the year also included an amount that was also paid in advance. Okay. Now let us see the accounting treatment of this thing. Okay. We know that prepayments have a debit balance because we've paid it in advance, so that is still our money, sort of an asset. When you have an asset, it is a balance it is a debit balance. So balance BD, we paid it. Remember that this was still our money, we paid it in advance. So we are going to debit 300 on an insurance account. But we also told during the year we paid a certain amount. We paid it. Now we paid because we paid it if we were using a bank account or cash account. If we paid it cash account or bank account, we credited that amount of money, and then we're going to debit this account as an expense, and then we paid 2,000 during the year. But we are also told at the end of the year there was still an amount unpaid. This is going to be balance carried down of 100 because that was within this amount that was paid within 2,000 that was paid. Now again we are going to close this with the normal procedure of closing an account. Which side is greater than the other? This side is greater than this side, so it is going to be 2,300. Again here 2,300, and then the difference here is the one that we're going to take it to the P&L. The difference is the one that we're going to take it to the profit and loss account, which is going to be 2,000 and 2,200. Okay, this is the difference that we're going to take it to the profit and loss account. You see the way it is very, very simple. Now from it, you can be able to establish which other element is going to be taken to the income statement, and to the balance sheet, and which other element is going to be taken to the income statement. This one is going to be taken to the profit and loss account, which is like saying to the income statement, and the closing balance is going to be taken to the balance sheet, and prepayments being the current assets. Okay, so you might also be told to come up with an extract of profit and loss. And again, also you might be also told to come up with an extract of of a balance sheet, okay, with a prepayment. An extract of the profit is an extract. You're going to write a profit and loss account for the period ending 31st December 2020. Then here, under the expenses, you'll have the insurance. How much was insurance? 2,200. Okay, so a simple statement. Okay, simple statement. Again, an extract of the balance sheet. You're going to write here a balance sheet for the period ending that. That amount is going to be under the current assets. Now we know that all prepayments. So you have to write here prepaid. This is prepaid insurance or insurance prepaid of 100. That is an extract of a balance sheet. I hope you can read it. I've seen my marker pen is not writing that much, but I hope you can capture, and the fact that you can follow what I'm trying to say, you'll be able to understand it. Okay. So that is the treatment of prepayments and accrual. That is simple treatment of prepayments and accrual. Okay. Now, if you analyze it, you can be able to observe something. The examples that I was giving, it was only based on expenses, that accrued expenses and then prepaid expenses. But actually, we don't have expenses only that has been accrued or prepaid. Okay, sometimes it might be also having revenue. Now, I'm giving you an example for an accrued revenue, revenue that has been accrued. Now, let us now use an example that went far way back. Let us assume that on 1st January, on 1st January of 2006, you have a commission receivable owing 400. Commission receivable is the commission that you are supposed to receive, but you have not yet received. So you had a commission receivable owing 400, and then during the year, the business received probably a commission of 6,500. During the period, you received a commission of 6,500, and then, however, 500 of the commission is still owed at the end of the period. Let us assume. Here, let me open an account. You're also going to have a T account again. You have your debit, your credit. Now remember, our aspect here is accrued revenue. So this is your commission received. Commission receivable owed. Let us write commission received. Commission received. It is an account received. Commission received. Okay. Commission received. Accrued revenue. Now we are told we know that revenue has a nature of credit. If you receive revenue, you are supposed to credit it. But this, since this amount was not received, it was supposed to be received. It is going to be on the other side. Then you're saying the balance brought down that this was supposed to be received, but it was not received, so it was still unpaid. We have a balance brought down of 400. It should be debited. But we are also told during the year we received. Now we received a commission of 6,500. So since you receive commission, it is going to be credited. And then we are also told that at the end of the year, we were supposed to receive some amount of money, but we did not receive that amount of money. That amounted to 500, okay? So by saying that, let us see how we are going to close and see which amount should be treated as should be treated to the profit and loss during the year as as received the commission, and that should be either debited or credited. But we know that this figure, it is going to be credited to the P&L, since it is an income commission received. Okay. Now the difference here is going to be which side is bigger. This side is bigger. It's going to be 7,000, because this is 6,500 plus 500, 7,000, and here it is going to be 7,000. The difference here is going to be 6,600. So this is the one that is going to be taken to the P&L, to the profit and loss. So we're going to take this amount to the profit and loss. We're going to take 6,600 to the profit and loss as an income for the year. Okay. Now, to come up with an extract, as I've said, you might be told to write an extract of an income statement or balance sheet or profit and loss account. Of course, with your PL, just go to the PL, profit and loss account for the period ending 20. We give an example for the period 2019. So under gross profit there, you're going to add, because this is an income, you're going to add commission received of 6,600. This is the commission received. That is an extract, as simple as that. Okay. Now, an extract of a balance sheet. This is a balance sheet. Everything remains the same. Where are we going to put this one? This is an accrued receivable. Something that is accrued, you are entitled to receive. To you, it is an asset, so it is going to be under current. It is going to be under current assets. Under current asset, you're going to have accrued commission receivable. Accrued commission receivable. Of how much? Receivable. Of how much? Of 500. As simple as that way. Okay. I hope now you can be able to clear that. Okay. Now, if you have an accrued revenue, then expect to have an accrued prepaid revenue. Okay. So the treatment should be vice versa. If you have an accrued revenue, then expect to have a prepaid revenue. I think I should give you an example of a prepaid revenue to make it clear. An example of prepaid revenue. Okay. Now let us assume that we have a business that has a financial year ending again 31st. We're going to use the same example, but on 1st January of that year, then you have rent receivable, because it is a prepaid. You have rent receivable paid in advance of 350. During the year, business rent received was assumed like it was 2,250. But however, this figure includes 500 of rent receivable that was prepaid during the year. Now, I'm not supposed to write then again, because we have been writing the same thing. I'm just going to give you an accounting treatment. Okay. An accounting treatment. Now we have rent receivable, so we're going to open an account of rent receivable. I want to show you when you have a prepaid revenue. Now you have a rent account. Now, since there was an amount that was paid in advance, an income that was paid in advance, so that income is not us, it's not ours, but since it was paid in advance, so we have a balance paid, because it was an income that was paid. It is under the credit side, so we have an income of, we are told that we have an income of 350. an assumption that this amount was paid in advance. But again, during the year, there was an amount that was paid. We assume that amount was paid through a bank of 2,500. That also included an amount in advance of 500, which means we are going to have a balance CD of 500 that is also included in this amount, because if we were paid 2,500 in advance, there was this amount, so of course it makes sense to make it on the other side, okay? Because this one, this amount, to reduce the amount that was paid in advance. Sometimes you should use common sense to understand, because accounting is very practical. It's very, very practical. Even the debit and credit can help you to see if you are adding or if you are deducting an amount from it. Okay. Now, if you close it, you're going to see which amount goes to the profit and loss account. On this side, you're going to get to 850. Okay. Because it's 50, and then this is bigger. It's 2,850. And the difference would be 2,350. Okay, this is the one that is going to be taken to the profit and loss account. It's the one that is going to be taken to the profit and loss account. So you might also be asked to prepare an extract. Simply, if you are told to prepare an extract, this one, since you see it is on the debit side, so it is going to be on the credit side. So you're going to add it under the revenue, under the gross profit. You're going to add it as a revenue. But again, this amount, you see it is on the debit side. It is going to be a prepaid rent receivable here. But on the other side, when it is going to be treated, it is going to be a liability, because that is not your money. It has been paid to you in advance, so it is not. It is of course it is a liability. Okay. Let me open an extract. An extract of profit and loss account for the period ending. Let us assume 31st December 2020. Then under the gross profit here, you're going to add rent received. How much you're going to write to add to the one that figure that was taken to the P&L, 2,350. So this is an extract, okay? That is the gross profit. You show that you have an amount of gross profit, then you add this figure, okay? Again, an extract of the balance sheet. So this is the balance sheet for the period ending. Now, since this amount, as I've said, it was paid in advance, it is still receivable. So it's not your money. You're going to put it under current liability. You're going to write it prepaid rent receivable. Prepaid rent receivable for an amount 500. So that's it. That's an example. I think it's very clear for you to see the treatment of prepayments and accruals and revenue and expenses. Okay. Should I add another example? I think let me add you with the last example. Okay. I should add you the last example. I should add that last example that can strengthen an understanding of prepayments and accrual. Now let us assume we have a stationary account. So we're going to use a stationary account. Let us assume we have a stationary account, and a business is a financial year ending 31st December, because that makes sense for you to be able to understand, because that is at the end of the year. And then on 1st January, we have a stock of stationery of let us assume 260. That was a stock. And during the year, the business paid stationaries. During the year, we paid stationaries. Paid stationery of 206.50. So this was paid for stationaries. But despite this amount that was paid, there was still an outstanding invoice that we paid this amount during the year. But at the end of the year, there was still, at the end of the year, that means 31st December 2019, there was still outstanding invoice of an amount, let's say 150. So this was outstanding amount. At the end of the year, there was still outstanding amount of an invoice 150. But also, we had closing stock, or we had stock of stationery. Should I write closing stock, or I should say we had stock? At this 31st December, we had a stock of stationaries that amounted to 300. So this is the case, okay? I've tried to summarize here. This is our stationery account. I've tried to summarize here that we have an accounting period that runs to 31st December 2019, but at the start of the year we had a stock of 260, and then during the year we paid this amount for stationaries. But at the end of the year we are having an outstanding invoice of 150, but still we were also having a stock that worth 300. Okay. Now let us see the accounting treatment, because now from that point we also we have elements that needs adjustment. Okay. Now let us open our stationery account. I'm going to open my stationery account under T account, debit. I'm going to write debit, credit, and I'm told that by the start of the year I was saving a stock that is balance breakdown of 260. So this was the start of the year, but also we the business paid for stock. So let us assume that it was paid by towards the bank, an amount of 2,650. So we paid this amount for stationery, for stock of stationery. But we are also told at the end of the year, balance carried down, we were also having stock of 300. But also out of that, there was still outstanding invoice of 150, which is an invoice that was not paid. Okay, outstanding invoice of 150. So let us see which amount goes to the P&L. Okay. I think might be asking me why we have two closing balance and we have one balance here. It is simply, this is outstanding amount, this is the closing amount. Of course, it is going to be this side. This is the amount that was paid during the year. This was the opening balance. Okay, so the difference here, if you add this and this one, then you are going to get 3,000 and 3,060. So it's going to be bigger this side, 3,060. If you less here, you're going to get 2,760. This is the amount that should be taken to the P&L. This is the amount that should be taken to the P&L. 2,760. 2,760 should be taken to the P&L. Okay, so that's very, very important. But again, Now you have two elements here. You have accrued stationery and prepaid stationery. Why? You have two elements here. That's why I gave you an account, stationery account, because sometimes you might be having two elements, prepaid ones and accrued one. Because here this invoice 150 was still unpaid, so this is accrued. It was supposed to be paid. But again, you have 300. This one 300 is prepaid stationery, because we have stationery at the end that was prepaid. Okay, so we are going to have an extract. You're going to have two elements here on the balance sheet. Okay, this one is going to be on current assets, and this one is going to be on the accrued expenses. But this one is going to be on your P&L account as an expense, because it is an expense under the column whereby you're going to put down your expenses. Okay. Let me finalize by writing it here, so that you see an extract. Okay. This is an extract. Profit and loss account for the period ending 31st December, let's say 2019. Assume that this transaction were under 2019. So here you're going to, when you're going to less expenses, and expenses you're going to write stationery expenses of an amount 2,760. As simple as that. Okay. Simple and clear that way. Okay. And the balance sheet and extract. Remember, this is an extract. This is an extract of a balance sheet. Extract of a balance sheet for the period ending 31st December. You're going to have two elements under the current assets. Under the current assets, you're going to have a prepaid stationery. You're going to have a prepaid stationery of 300. This was prepaid, but again under current liability, you're going to have accrued stationery of an amount 150. So it is simple. It is clear as that way. Okay. So by saying, or by giving these examples, I hope that no one should be troubled with the treatment of accruals and prepayment, because I've tried to give you a number of examples and the accounting treatment of how these transactions should be treated. Okay. Maybe I can give you some of the tips that you have to take them into consideration. One, you have to use the correct words, or when you're going to narrate, for example, the words like opening balance, closing balance in your ledger accounts, because if you're not going to use it correct, that might be misleading you when you want to treat these accrual, because it's very, very important. You've seen elements like the opening balance. Okay, now we know this is the opening balance. The closing balance, now we know, for example, with the stock, when it is named as closing balance, now we know, okay, this is the stock, the amount of the stock that is remained at the end of the accounting period, and this is the accounting treatment. Likewise with the opening stock. So that's one important. But again, the heading is very, very important. If you're going to address the balance sheet, be sure that you're going to address the balance sheet. If you're going to address the income statement, be sure that you're going to address the income statement, and remember to put the names there, the name of the organization, and so forth. Up to that point, I thank you for being with me today. I hope you've enjoyed. Feel free to ask me. There is my number. I'm going to put my number at the end of this session, but still you can either contact me through my email to be able to reach me, so that if you feel that there are some areas that you need more explanation, then I'll be free available to help you in this course. Thank you so much, and I hope we will still keep in touch.